Question 1. Which of the following is an example of risk transfer in insurance? A. Purchasing insurance to cover potential losses from a car accident. B. Making changes to business practices to reduce accidents. C. Setting aside a reserve fund to pay for future claims. D. Educating employees to avoid risky behavior. Answer A. Purchasing insurance to cover potential losses from a car accident. Explanation. Risk transfer occurs when an individual or organization shifts the financial consequences of a risk to another party. In this case, purchasing insurance transfers the risk of financial loss due to a car accident to the insurance company. This is the most direct example of risk transfer, which is a core principle in insurance. Other options, B, C, D, involve risk reduction, retention, or avoidance rather than transferring the risk to another party. Question 2. Scenario. Sarah has a homeowner's insurance policy with an exclusion for flood damage. After a severe rainstorm, her basement is flooded, causing $10,000 in damage. Which of the following is correct regarding Sarah's claim? A. Sarah will be fully reimbursed for the flood damage because the rainstorm was not her fault. B. Sarah can file a claim, but the damage will not be covered because of the exclusion for flood damage. C. Sarah will be reimbursed for the flood damage, but only for damage caused by the rainstorm, not the flooding. D. Sarah will be reimbursed for the full $10,000 because her insurance is a comprehensive homeowner's policy. Answer B. Sarah can file a claim, but the damage will not be covered because of the exclusion for flood damage. Explanation. Insurance policies typically include exclusions for specific types of damage, such as flood damage. In Sarah's case, her homeowner's insurance includes an exclusion for flood damage, so despite the rainstorm causing the damage, it will not be covered by her policy. Understanding exclusions in insurance contracts is essential for both agents and policyholders. This scenario tests the ability to recognize policy exclusions and their impact on claims. Question 3. Which of the following is true about underwriting and risk selection in insurance? A. Underwriting solely considers the financial stability of the applicant. B. A high-risk applicant can still be approved for coverage if they are willing to pay a higher premium. C. Underwriting does not include the evaluation of an applicant's medical history for life and health insurance. D. Underwriting is only concerned with determining the exact premium amount for a policyholder. Answer B. A high-risk applicant can still be approved for coverage if they are willing to pay a higher premium. Explanation. Underwriting involves assessing an applicant's risk profile, including their financial stability, medical history for life and health insurance, and other factors. While underwriting aims to assess and mitigate risks for the insurer, it is not uncommon for high-risk applicants to still be approved for coverage, albeit at a higher premium. This ensures that the insurer can offset the higher risk with a higher price. Option A is incorrect because underwriting involves more than just financial stability. It considers other factors like health, occupation, and lifestyle. Option C is incorrect because medical history is a significant component of underwriting in life and health insurance. Option D is also incorrect as underwriting focuses on assessing risk, not just determining premiums. Question 4. Which of the following statements about the principle of indemnity in insurance is correct? A. Indemnity allows the insured to make a profit from their insurance policy after a loss. B. The purpose of indemnity is to restore the insured to the same financial position they were in prior to the loss, but not exceed it. C. Indemnity eliminates the risk of loss for the insured. D. Indemnity applies only to property insurance policies and not to life insurance policies. Answer B. The purpose of indemnity is to restore the insured to the same financial position they were in prior to the loss, but not exceed it. Explanation. The principle of indemnity ensures that an insured person is compensated for a loss up to the amount of their financial loss without allowing them to profit from the insurance. This prevents moral hazard where people might cause loss intentionally to collect more from the insurer. Option A is incorrect because indemnity limits recovery to the actual loss. Option C is incorrect because indemnity doesn't eliminate risk, it simply compensates for it. Option D is incorrect because indemnity applies to both property and life insurance, although life insurance is generally a fixed payout, which is an exception. Question 5. Which of the following statements accurately reflects the role of an insurance producer, agent, or broker? A. An insurance producer is only responsible for selling policies and does not handle claims. B. An insurance producer can provide legal advice about the terms and conditions of an insurance policy. C. An insurance producer has a fiduciary duty to act in the best interests of the client. D. An insurance producer can modify the terms of an insurance contract without the insurer's approval. Answer C. An insurance producer has a fiduciary duty to act in the best interests of the client. Explanation: insurance producers, whether agents or brokers, must act in a fiduciary capacity, meaning they must prioritize their client's interests over their own. They must ensure that the client is provided with the right coverage, explained accurately, and is informed about their choices. Option A is incorrect because while insurance producers primarily sell policies, some producers, especially brokers, may assist clients with claims. Option B is incorrect because insurance producers cannot give legal advice. They are required to provide factual information about the insurance policy. Option D is incorrect because insurance producers cannot change the terms of an insurance contract without authorization from the insurer. Question 6. Scenario: Mr. Thompson, a homeowner, discovers that his home has sustained significant fire damage. He files a claim with his insurance company, but the insurer offers him a settlement that is significantly lower than what he believes is reasonable. What is Mr. Thompson's best course of action? A. He should immediately accept the insurer's offer and sign the settlement. B. He should file a complaint with the Washington Department of Insurance to dispute the settlement offer. C. He should consider negotiating with the insurer or hire an independent adjuster to assess the damage and help resolve the dispute. D. He should contact a lawyer to file a lawsuit against the insurance company without attempting to negotiate. Answer: C. He should consider negotiating with the insurer or hire an independent adjuster to assess the damage and help resolve the dispute. Explanation: when an insured person disagrees with an insurance settlement, the first step is often to negotiate the offer with the insurer or work with an independent adjuster to get a fair assessment of the damage. This is generally the most effective way to resolve disputes without escalating to legal action. Option A is incorrect because accepting an unfair offer could result in a financial loss. Option B may be appropriate if negotiations fail, but typically the first step is negotiation. Option D is incorrect because taking legal action should only be pursued if all negotiation options have been exhausted. Question 7. Which of the following is an example of adverse selection in the insurance industry? A person who has a high-risk occupation applies for insurance and the insurer adjusts the premium to reflect the increased risk. B. A person with a history of chronic illness applies for health insurance and the insurer issues a policy with a higher premium or exclusions. C. An individual buys a life insurance policy and then later discloses a pre-existing condition to the insurer. D. A person with low risk factors applies for a policy and receives the same rate as others in the same demographic. Answer: B. A person with a history of chronic illness applies for health insurance and the insurer issues a policy with a higher premium or exclusions. Explanation: adverse selection occurs when individuals with higher than average risks are more likely to purchase insurance, which can lead to unbalanced risk pools and financial strain on the insurer. Option B is an example because a person with a chronic illness poses a higher risk to the insurer, which may result in higher premiums or exclusions. Option A is incorrect because adjusting the premium based on occupation is not a result of adverse selection but rather an appropriate risk assessment. Option C is incorrect because disclosing a pre-existing condition is part of proper underwriting and it is not an example of adverse selection. Option D is an example of fair pricing, not adverse selection. Question 8. Which of the following is true about Washington state's insurance fraud laws? A. Insurance fraud can only be committed by insurance agents, not policyholders or claimants. B. Insurance fraud is a criminal offense in Washington state and can result in both civil and criminal penalties. C. Only insurers can be investigated for fraud under Washington state law. D. Washington state law does not require insurance producers to report suspected fraud. Answer: B. Insurance fraud is a criminal offense in Washington state and can result in both civil and criminal penalties. Explanation: insurance fraud is taken very seriously in Washington state and can lead to both criminal and civil penalties. The state actively investigates fraud across all parties involved, including policyholders, insurers, and agents. Option A is incorrect because both policyholders and claimants as well as agents can be guilty of fraud. Option C is incorrect because anyone involved in fraudulent activities related to insurance, including producers, can be investigated. Option D is incorrect because insurance producers are legally required to report suspected fraud to the appropriate authorities. Question 9. What is the main purpose of a standard policy in insurance? A. To provide a one-size-fits-all coverage option that suits all customers. B. To set uniform terms and conditions that apply to all insurers within a specific market or type of insurance. C. To ensure that insurers cannot modify policy terms to meet the specific needs of individual clients. D. To offer a policy with lower coverage limits and fewer options for a reduced premium. Answer B. To set uniform terms and conditions that apply to all insurers within a specific market or type of insurance. Explanation. A standard policy serves as a model or template for insurers within a specific insurance type, ensuring that the terms and conditions are uniform and comply with regulatory standards. This helps create consistency in the market and protects consumers. Option A is incorrect because standard policies do not aim to cover everyone equally but set a baseline for coverage. Option C is incorrect because insurers can customize policies with endorsements or riders. Option D is incorrect because a standard policy doesn't necessarily mean lower coverage. It is just a standardized version of coverage that meets basic requirements. Question 10. Which of the following is an example of a rider in an insurance policy? A policy provision that adds coverage for specific risks not included in the original policy. B. A policy exclusion that removes coverage for certain types of losses. C. A deductible that the insured must pay out of pocket before the insurance policy applies. D. A clause that automatically renews the policy each year without requiring further action from the insured. Answer A. A policy provision that adds coverage for specific risks not included in the original policy. Explanation. A rider is an additional provision added to an insurance policy to provide extra coverage or modify the terms of the standard policy. Riders can cover specific risks or provide additional benefits that are not included in the original policy. Option B describes an exclusion, not a rider. Option C refers to a deductible, not a rider. Option D refers to an automatic renewal clause, which is different from a rider. Question 11. Which of the following is not typically considered a characteristic of an insurance contract? A. The contract is enforceable by law. B. The contract is a mutual agreement between the insurer and the insured. C. The contract is legally binding and does not require a written document. D. The contract contains terms that specify coverage and exclusions. Answer C. The contract is legally binding and does not require a written document. Explanation. Insurance contracts are typically required to be in writing to be enforceable. While they are legally binding, the written form provides clarity and helps avoid misunderstandings. Option A is incorrect because insurance contracts are enforceable by law. Option B is incorrect because insurance contracts are indeed mutual agreements. Option D is incorrect because contracts always include terms and exclusions. Question 12. Which of the following is an example of moral hazard in insurance? A. A person with a high-risk occupation purchases a life insurance policy. B. A policyholder increases their deductible after a loss to lower their premium. C. A policyholder becomes more reckless in their behavior after purchasing insurance, knowing that the insurer will cover potential losses. D. A homeowner purchases additional coverage after experiencing a loss to protect against future incidents. Answer C. A policyholder becomes more reckless in their behavior after purchasing insurance, knowing that the insurer will cover potential losses. Explanation. Moral hazard occurs when an individual's behavior changes as a result of being insured, often leading to riskier behavior because they know that insurance will cover the potential loss. Option A is an example of policyholder purchasing insurance based on their occupation, not moral hazard. Option B is reasonable decision to manage premiums, not moral hazard. Option D is an example of good risk management, not moral hazard. Question 13. What is the primary purpose of the coinsurance clause in property insurance? A. To allow the insured to share a portion of the claim payment with the insurer. B. To reduce the amount of premium paid by the insured. C. To encourage policyholders to maintain coverage limits that reflect the value of their property. D. To increase the payout amount for the insured after a loss. Answer C. To encourage policyholders to maintain coverage limits that reflect the value of their property. Explanation. The coinsurance clause is designed to encourage policyholders to insure their property for its full value. If the property is underinsured, the insured may have to pay a portion of the loss. Option A is incorrect because coinsurance doesn't mean sharing claim payment, but rather reflects the insured's responsibility for underinsured property. Option B is incorrect as it does not reduce premiums directly. Option D is incorrect because it does not increase payout, it enforces penalty for underinsurance. Question 14. What is the main function of the insuring agreement in an insurance policy? A. To explain the duties of the insured in the event of a claim. B. To specify the type and amount of coverage provided under the policy. C. To list the exclusions that will not be covered under the policy. D. To outline the process for renewal of the insurance policy. Answer. B. To specify the type and amount of coverage provided under the policy. Explanation. The insuring agreement outlines the insurer's promise to provide coverage for specific risks, losses, or damages as outlined in the policy. Option A refers to the conditions, not the insuring agreement. Option C refers to the exclusions clause, not the insuring agreement. Option D refers to the renewal terms, not the coverage provided. Question 15. Which of the following is true about the warranty in an insurance policy? A. A warranty is a statement of fact that, if false, can void the insurance contract. B. A warranty is a promise made by the insurer to provide coverage for all possible risks. C. A warranty is an optional part of the policy that can be ignored by the insured. D. A warranty is a vague statement about coverage that may be interpreted differently by the insurer and insured. Answer A. A warranty is a statement of fact that, if false, can void the insurance contract. Explanation. A warranty is a promise or statement of fact made by the insured that must be true throughout the life of the contract. If the warranty is false, the insurer may void the policy. Option B is incorrect because a warranty is a condition of the insured, not the insurer. Option C is incorrect because warranties are required by the insured to remain valid. Option D is incorrect because warranties are specific and factual, not vague. Question 16. Scenario. A vehicle insurance policyholder submits a claim for a collision after rear-ending another car, and the insurer suspects the insured is at fault due to negligence. The insurer decides to investigate the incident further. Which of the following is the insurer's primary responsibility in this situation? A. The insurer should pay the claim in full and not investigate further. B. The insurer should investigate the claim and determine whether the insured is liable based on the facts of the case. C. The insurer should automatically deny the claim because of the suspicion of negligence. D. The insurer should offer partial settlement based on the suspicion of negligence. Answer. B. The insurer should investigate the claim and determine whether the insured is liable based on the facts of the case. Explanation. The insurer has an obligation to thoroughly investigate claims before deciding whether the insured is liable. This helps ensure that the insurer's decision is based on facts and not assumptions. Option A is incorrect because the insurer cannot pay without verifying the facts. Option C is incorrect because the insurer should not deny the claim without a full investigation. Option D is incorrect because the insurer must determine liability based on the facts, not assumptions. Question 17. Which of the following is an example of a third-party claim in insurance? A. A homeowner files a claim for damage to their own property caused by a fire. B. An individual files a claim for injuries sustained in a car accident where they were at fault. C. A person files a claim for damages caused by another driver in an accident. D. A business files a claim for damages to its own property after a storm. Answer. C. A person files a claim for damages caused by another driver in an accident. Explanation. A third-party claim occurs when someone other than the policyholder files a claim. In this case, the person is filing a claim for damages caused by another driver, third party. Option A is incorrect because this is a first-party claim where the policyholder is filing a claim for their own damage. Option B is incorrect because it is a first-party claim by the person who caused the accident. Option D is incorrect because it is a first-party claim for a business's own property. Question 18. Which of the following types of insurance policies typically provides coverage for legal defense costs in addition to liability limits? A. Homeowners insurance. B. Umbrella insurance. C. Health insurance. D. Term life insurance. Answer. B. Umbrella insurance. Explanation. Umbrella insurance provides liability coverage above and beyond the limits of other insurance policies, such as auto or homeowners insurance, and often includes coverage for legal defense costs. Option A is incorrect because homeowners insurance typically does not cover legal defense costs. Option C is incorrect because health insurance does not provide liability coverage. Option D is incorrect because term life insurance provides death benefits, not liability or legal defense coverage. Question 19. What is the primary purpose of the exclusions section of an insurance policy? A. To clarify the conditions under which the insurer will pay the claim. B. To specify what is not covered under the policy. C. To provide an outline of the premium payment schedule. D. To list the rights and duties of the insured party. Answer B. To specify what is not covered under the policy. Explanation. The exclusions section outlines the risks, events, or circumstances that are not covered by the insurance policy, ensuring both the insurer and the insured are clear about limitations. Option A is incorrect because exclusions specify what is not covered, not what is. Option C is incorrect because premium payment schedules are found in the terms, not exclusions. Option D is incorrect because rights and duties are typically found in the conditions section of the policy. Question 20. Which of the following is an example of a non-renewal of an insurance policy? A. The insurer offers to extend the policy with the same terms and premium. B. The insurer decides not to offer a renewal at the end of the policy term. C. The insurer increases the premium but continues coverage. D. The insurer modifies the policy to provide additional coverage options. Answer B. The insurer decides not to offer a renewal at the end of the policy term. Explanation. Non-renewal occurs when the insurer decides not to continue the insurance coverage after the policy term ends. This is different from cancelling or renewing the policy. Option A is incorrect because this describes renewal, not non-renewal. Option C describes a premium increase but is not non-renewal. Option D describes a modification of the policy, not non-renewal. Question 21. Which of the following is a key factor that determines the premium for an auto insurance policy? A. The age of the insurer. B. The type of vehicle being insured. C. The amount of coverage under the policy. D. All of the above. Answer D. All of the above. Explanation. The premium for an auto insurance policy is influenced by multiple factors, including the age of the insured. Older drivers may have lower premiums. The type of vehicle being insured, expensive or high-performance cars may have higher premiums, and the amount of coverage selected. Question 22. What does subrogation refer to in an insurance contract? A. The process by which the insurer reimburses the insured for a claim. B. The process by which the insurer seeks to recover costs from a third party responsible for the loss. C. The practice of the insurer cancelling a policy for non-payment of premiums. D. The process of setting premiums based on the risk assessment of the policyholder. Answer B. The process by which the insurer seeks to recover costs from a third party responsible for the loss. Explanation. Subrogation is when the insurer pays for the insured's loss and then seeks to recover those costs from a third party responsible for the damage. Option A describes reimbursement, but it's not subrogation. Option C refers to cancellation for non-payment, which is unrelated to subrogation. Option D refers to underwriting, not subrogation. Question 23. Which of the following is a typical characteristic of a claims-made insurance policy? A. Coverage applies to incidents that occur during the policy period, regardless of when the claim is filed. B. Coverage applies only if the claim is made during the policy period, regardless of when the incident occurred. C. The policy provides coverage for incidents that occur before the policy starts. D. The policy has no time limitations for claims reporting. Answer B. Coverage applies only if the claim is made during the policy period, regardless of when the incident occurred. Explanation. A claims-made policy provides coverage for claims made during the policy period, regardless of when the incident that triggered the claim occurred. Option A describes an occurrence-based policy, not a claims-made policy. Options C and D are incorrect because they do not align with the characteristics of a claims-made policy. Question 24. Which type of insurance would typically cover medical expenses incurred due to injuries sustained while traveling outside of the United States? A. Homeowners insurance. B. Travel medical insurance. C. Auto insurance. D. Renters insurance. Answer B. Travel medical insurance. Explanation. Travel medical insurance specifically covers medical expenses incurred while traveling abroad, including injuries sustained outside the United States. Option A, C, and D are incorrect because those insurance policies do not typically cover medical expenses incurred while traveling internationally. Question 25. Which of the following is an example of an active gun in an insurance policy? A. A car accident caused by the insured's negligence. B. A natural disaster such as an earthquake or flood. C. A claim filed due to fire damage from faulty wiring. D. A theft that occurs due to a lack of security measures. Answer B. A natural disaster such as an earthquake or flood. Explanation. Like to God refers to an unforeseen natural event that is outside human control, such as earthquakes, floods, or storms. These are typically excluded or require separate coverage in insurance policies. The other options refer to situations that are not typically classified as acts of God. Question 26. Which of the following best describes underwriting in the context of insurance? The process of evaluating a claim and determining the amount to be paid. B. The process of reviewing an applicant's risk and determining the terms of the insurance policy. C. The process of determining the premiums based on the policyholder's age. D. The process of investigating claims to identify fraud. Answer B. The process of reviewing an applicant's risk and determining the terms of the insurance policy. Explanation. Underwriting is the process by which an insurer evaluates the risk of insuring person or entity and sets the terms, coverage, and premium for the policy. Option A refers to claims adjusting. Option C is factor considered in underwriting but not the whole process. Option D refers to claims investigations, not underwriting. Question 27. Which of the following is a typical exclusion in a standard homeowner's insurance policy? A. Theft of personal property inside the home. B. Water damage caused by a burst pipe. C. Flood damage caused by a natural disaster. D. Fire damage caused by a lightning strike. Answer C. Flood damage caused by a natural disaster. Explanation. Homeowners insurance typically excludes coverage for flood damage. This requires separate flood insurance, which is not included in a standard homeowners policy. The other options represent typical scenarios that are covered under standard homeowners insurance. Question 20. What does the loss of use coverage in an auto insurance policy typically cover? A. The cost of repairing a damaged vehicle. B. The cost of renting a vehicle while the insured vehicle is being repaired. C. The legal fees associated with an accident. D. The medical expenses for injuries caused by an accident. Answer B. The cost of renting a vehicle while the insured vehicle is being repaired. Explanation. Loss of use coverage typically pays for rental car costs while the insured vehicle is being repaired after a covered loss. Option A is incorrect because it refers to collision coverage. Option C refers to liability coverage. Option D refers to medical payments or personal injury protection (PIP). Question 29. Which of the following best describes the deductible in an insurance policy? A. The amount the insurer will pay for a claim after it is approved. B. The amount the insured must pay out of pocket before the insurer begins covering a claim. C. The amount added to the premium to increase the level of coverage. D. The amount the insurer charges for cancelling the policy. Answer B. The amount the insured must pay out of pocket before the insurer begins covering a claim. Explanation. A deductible is the amount the insured must pay out of pocket before the insurer starts covering the claim. Option A describes the claim payment, not the deductible. Option C refers to the premium, not the deductible. Option D refers to cancellation fees, not the deductible. Question 30. In the context of liability insurance, what is negligence? A. The intentional act of causing harm or damage. B. The failure to take reasonable precautions to avoid causing harm or damage. C. The act of filing a fraudulent claim. D. The failure to provide insurance coverage for a risky activity. Answer B. The failure to take reasonable precautions to avoid causing harm or damage. Explanation. Negligence refers to the failure to exercise reasonable care, which results in harm or damage to others. In liability insurance, negligence is often the basis for claims. Option A refers to intentional torts, not negligence. Option C describes fraud, not negligence. Option D refers to a failure to insure against risks, not negligence.